Honorable Chief Guest, the High Commissioner of India, ladies and gentlemen, thank you IBFB for inviting me to speak on the state of the economy. I'm going to take you through a tour of facts on the key long-term trends and then the current state of the economy. And I will conclude with a forward look on the economic policy reset that we need, and also the medium and long-term challenges. Now, if you start with the long-term trends in the Bangladesh economy, there are three things that stand out. One is the structural change. Number two is a sustained improvement in the standards of living. And number three is increased inequalities. On the first one, you can see in this chart that there is a sustained increase in GDP per capita and acceleration of growth. Now, to understand where this growth came from, the World Bank last year did a very comprehensive report known as Country Economic Memorandum. And in that report, they unbundled the growth. The unbundling was in terms of three components. One is what's called the persistence of growth. Growth depends on its own past history, or you could think of it as echo of the past. The other component is policy innovations. And the third one is the part that we really do not know. So that's one you're calling the residual. So I'm just going to, the World Bank used an empirical model to do this exercise, but I'm going to just present the bottom lines, the final results. What do we see? What we see is that growth in Bangladesh largely came from policy innovations during the period 1990 to 2004. Subsequently, most of the growth was actually persistence, that is echo of the past. More recently, in 2015 to 19, we notice an increase in the residual part, that is the part that cannot be explained by these factors that are included in the growth model to do the breakup. Now, one explanation of this could be measurement errors. There could be other explanations. But it does seem that there was the acceleration of growth was kind of tapering off. And a further evidence on that is the trade intensity of the economy and the investment intensity of the economy. What you see, there has been a rise in the trade intensity, but then subsequently it declined, and the decline was greater during the pandemic. There was a bit of recovery later. but we are still not back to the peak of trade intensity that we had achieved during FY10, FY11. On the investment side, there has been some increase in the private investment to GDP ratio, but that is also tapering off, and investment GDP ratio has remained more or less stable, and recently we're just seeing some decline. Another thing to note on these long-term trends is the correlation between the trade intensity and GDP growth and investment intensity and GDP growth. These are moderate, less than what one would expect. And that is symptomatic of some resource allocation problem in the economy. Needs deeper digging. Now, with growth came improvement in standard of living, and we recently got results from the Household Income and Expenditure Survey, which showed that during the period 2016 to 2022, 11 million people, which is slightly higher than half of Sri Lanka, were lifted out of poverty. About 5.4 million people, which is almost the same as the size of New Zealand, were lifted out of extreme poverty. Now, it's not just that the standard of living improved on consumption poverty, but broader indicators, which is the multidimensional poverty indicators, they also show significant improvement. And as you can see in that chart, here in the MPI, poverty is measured in terms of the international poverty line used for the low middle income countries, which is $3.65 per day. And then there are other indicators of standard of living, such as the number of children out of school, adults completing primary education, electricity, water, and sanitation. And all these indicators, we see a significant improvement in the standard of living. But at the same time, we have to keep in mind that there are still 32 million people, which is about the size of Nepal, who are below poverty. And there are about 9.8 million people who are below the extreme poverty line, and that's almost the same as the size of the United Arab Emirates. So that brings me to the question of inequality. And on that front, we see an increase. The most omnibus measure of inequality used is the Gini coefficient. That has increased from 4.58 to 4.82 to now close to 2.5. And this is higher than the global median, which is 0.36. This is the Gini income coefficient. So the income distribution has become unequal over time. And based on the Household Income Expenditure Survey 2022 data, I did some calculation of per capita income by deciles. What is the per capita income of the bottom 10% and next 20% and so on. So the results from that data show that 90% of Bangladeshi population still make about $10 per day. The bottom 50% income per capita per day is about $4, whereas the top 1% income per capita per day is about $110. So you have between the top 1% and the bottom 50%, there is very large inequality. And if you look at that chart, there is good news and there is bad news. The good news is at the very bottom, the real income growth between 2016 to 2022 was about 8.5% real income growth per annum, which is the second highest next to the 12.54% annual real income growth which we see in case of the top 1% of the population. Now, inequalities in income and wealth map into inequalities in the standard of living. So one question that you may ask is, okay, how do we explain the rise in inequality in Bangladesh? Now, what typically economists do is to look at the breakdown of income in terms of labor income and capital income. And the short answer to the question, what accounts for the increase in inequality in Bangladesh between 2016 to 2022, is that the capital income growth has stayed ahead of labor income. And that I give you some data here. Why did labor income growth fall short of the total income growth? There are two main reasons. One is that real wage growth has been less than labor productivity growth in all sectors, agriculture, industry, and services. And labor productivity in agriculture has declined. Employment and industry has also declined. So these account for the slower labor income growth relative to the total income growth. The second factor which explains inequality is, the question you may ask is, why did capital income growth stay ahead of labor income growth? And the standard economic explanation of that depends on the relationship between the return on capital and the overall growth rate in the economy. If the return on capital exceeds the overall growth rate on economy, then inequalities would rise. And that's what happened in Bangladesh as well. And you can see this is the data from the data on this World Inequality database, and the share of wealth, net personal wealth by different income groups. Top 1% owns 33.8% of net personal wealth, whereas the bottom 50% owns only 4.8% of national income wealth. So wealth inequality leads to income inequality, leads to consumption inequality. So that's my take on the long-term trends in the economy. Now let's go to the recent developments. On the recent developments, what stands out is there some cracks in macro financial stability. So let me start with the cracks. Where do we see those? One is this on growth. Now here I'm presenting some very new data which Bangladesh Bureau of Statistics has published very recently. This is GDP growth by quarters, quarterly GDP, which we have not had in the past before. Now, if you remember 2-3 years ago during the pandemic, when the global economy was in recession, there was a lot of talk about the geometry of recovery. What will be the shape of the recovery going forward? And we had various letters. Some said it will be U-shaped, it may be V-shaped, it may be L-shaped, it may be W. Some even said it could be like a K. Now, what do we see in the case of Bangladesh? Before the pandemic, you see little W's. growth going up and going down, going up and then going down. Then as the pandemic came, there was a big fall in growth. So we see a very large V. There was a big fall and then there was a very strong recovery of growth. Subsequently, there was another decline. And we seem to be heading towards another W type of trajectory of growth. But the bottom line here is this, that between 2019 to 2022, average growth between FY18 to 2020 second quarter was 7.6%. And the volatility of growth, the deviation around that 7.6% was about 2.7. Subsequently, average growth has declined and the volatility has increased. The difference between actual and average has increased. So that's why I'm saying that recently one crack in macro financial stability is the volatility in growth. And you may think, okay, you have data here till 2022, what about subsequently in 2023? Now we have annual data. We know that from BBS that their provisional estimate for FY23 GDP growth is 6%, a decline relative to the previous years, close to 7%. But we have proxy indicators which are closely related with GDP growth, and that is electricity. And here in this chart, I gave you the data on the daily consumption of electricity in FY22, 23, and 24. One thing that stands out in this chart is the high fluctuations. The too many drops, then rises in recent electricity consumption data. But the other thing that you notice from that deep red part of the chart is that in FY24 so far, the volatility has continued even though electricity consumption tending to be slightly going upwards relative to the same period the previous year, but there is still very large fluctuations. So the bottom line here is that we are seeing some volatility in activities recently. Second crack in macro stability is inflation, which is higher and is also more variable. During July 2019 to June 2021, average inflation rate was 5.6%, and the volatility was only 0.3. So inflation was very stable. But subsequently, average inflation has increased, and so also the variability of inflation. So inflation has also become volatile. And the other thing we notice in the data is that the inflationary dynamics has also changed. Previously, between 19 to 21, the relationship between the two big components of inflation, one is the food inflation and the other is the non-food inflation, they used to be negative. When food inflation increased, non-food inflation went down. So in a sense, inflation was fighting each other. But now, subsequently from 21, 22, this is actually 23, the correlation has changed. It has become positive, from negative to positive, which means food and non-food inflation are moving together. So there must be some common factors which is driving inflation. Third, cracks in macro stability we see is shortage in dollars, dollar shortage, and as you can see, this chart is self-explanatory that we had some rapid accumulation of reserves even during COVID and immediately after COVID, but then subsequently the reserves have been declining at a steady rate. And the line chart that you see here is the calculation of reserves based on the balance of payment manual 6.0, which is what the IMF recommends in terms of the reserve calculation methodology. But both indicators, gross reserves calculated according to Bangladesh Bank's definition and according to IMF's definition, both have been declining. And finally, on the cracks of macroeconomic stability is the risk indicator are going up, particularly in the financial sector. So I'm presenting this data on non-performing loans, not just as non-performing loans, but as a measure of overall risk in the economy, particularly in the financial sector. And you've seen that 2 days ago, we got more recent data on the last quarter, which also confirmed that they are increasing. Bangladesh Bank recently released the Financial Stability Report, where they also provided more detailed information on the components of loans that are not recognized as distressed, but should be. And that, if you take all of these together, that shows that by end June 2022, the total distressed asset in the banking system was about 22.8%. Now, the big question is, how do we explain what caused these volatilities or cracks in macro stability? And I think there are two parts to answering that question. One part is global shocks and their transmission. Now, the global shocks that matter for an economy like Bangladesh is the price of the dollar, is international commodity prices, and interest rates. The price of the dollar, US dollar index, has gone up. It's reached a peak on 26 September of 113. This is a dollar index with a base of 100 in 1973. Subsequently, it declined. Now it is also again tending to go up. Crude oil prices, which is a good proxy for commodity prices in general, they have gone up from 51.9 on 2nd March 2020 to a peak of 123 in March 2022. Subsequently, it declined to as low as 73.7, and now again it is tending to go up to 95. So we had, rise in oil prices, rise in prices of dollars, but both peaked and subsequently declined. What didn't decline at all, and we had this golden age of almost zero interest rate until 2021, and then you see a continued increase in interest rate. This is the secured overnight financing rate, which is what matters a lot for Bangladeshi businessmen. But there has been some slowdown in the rate of increase in the interest rate. But it's still from 0.08% in 2020, now it is up to 5.3%. So a very significant increase in interest rate. So the question now is, how did this get transmitted into Bangladesh economy? One major transmission mechanism was our balance of payments. We had surplus, which turned into deficit. But when our current account was started improving, we saw another problem in the financial account, which went into deficit. And there is a third item in the balance of payment, which is called errors and omissions. And these errors and omissions is actually the difference between foreign exchange inflows and foreign exchange outflows that is not explained by the changes in foreign exchange reserves of the country. So it is the unaccountable flows in the balance of payments. Now, all countries have these errors and omissions, but what typically one sees is that they are sometimes positive, sometimes negative. On balance, they wash out. What we are seeing in the case of Bangladesh, that recently this has become one-sided. That is always negative. So there is something going on which we don't know, but there are some outflows that are happening which is not captured in the official records. So that's one. Now, this international oil price increases, increased price of dollar, created balance of payment deficit in the country. That did two things. That depreciated the currency, and that also led to drawdown of reserves. But there are other transmission mechanisms that we're working, particularly the price adjustment of administered prices of oil and gas and other oil-related products, electricity, for example. These have also contributed to volatility in the economy. So that's one part of the answer to the question is, what explains the recent volatility in Bangladesh economy? Global factors. But that's not the full answer. A second part of the answer is policy shifts. Where do we see policy shifts? One is we recently a multiple and fixed exchange rate regime, which now has been unified in the sense that the multiplicity of rates have been eliminated, but for last 1 year, we did have a exchange rate regime that we did not have before. So that's one policy shift. A second policy shift we saw recently is a very unique monetary and financial policy, which is very hard to describe this policy because it has an expansionary component, external. By external expansion, what I mean is we see a rising growth of credit to the private sector. That slowed down. But when the private sector growth slowed down, the public sector growth increased. So we always had this credit expansion. And then at a time when inflation is rising, we also see nominal lending rates slightly declining. That's the expansionary part of the monetary policy. But there is also another part to monetary policy, which is the internal tightening. And this internal tightening you see in the data on excess liquidity in the banking system. That has been declining. And the policy rates, which Bangladesh Bank has increased in several steps, and that had influenced the call money rate, which is also on the rise. And third, we saw on the financial policy side that starting from COVID and before, there have been a lot of regulatory forbearance measures that Bangladesh Bank had introduced. So that's why I'm saying there is a mixture of expansion and contraction, and that's why the only term I found that can best describe this policy is that it is unique. You cannot say it was expansionary, you can't say it was contractionary. It was a mixture of both. And then we saw fiscal expansion. And in the fiscal history of Bangladesh, one thing you would notice is that Bangladesh budget always starts with a 5 to 5.1% deficit target. And the actual is always less than the budget target. And the reason for that historically has been that we underperform both on the expenditure side and on the revenue side. So we spend less than we wanted to, we collect less than we thought we would collect. But the underperformance on revenue has always been short of underperformance in expenditure, so deficits were smaller than targeted. What has happened is recently this has changed. Now we are underperforming less on expenditures and more on revenues, so deficits are now tending to going up. But the debt GDP ratio of Bangladesh is still relatively low compared to peer countries, and the debt sustainability parameters still suggest that what the level of debt that we have in the long term is still sustainable. We have not reached a point where debt has become totally unsustainable, but there is one concern, which is the liquidity concern, because even if you have sustainable debt, if you are short of liquidity, then you will not be able to meet your payments. So that's a dollar liquidity is a fiscal worry also. Now, we also have the IMF program. I'm giving you the details in the presentation. Don't worry, I'm not going to go through all the details. It covers a lot of areas, starting from fiscal to financial to policy and institutional framework. But it's too early to judge what the IMF program has done, because this is still pudding in the making, and the test of the pudding is in the eating. We still do not have it yet. Now, the forward look. First, I want to draw your attention some policy relevant facts. What do we know? What have we seen? Because what Bangladesh has followed in last, I would say, year and a half was a very unorthodox response to the global shock. But what are the results that we have gotten so far? One, we have seen about $1 billion of official reserve loss per month for last 24 months. We have seen a decline in remittance, which used to be on average $2 billion per month to now about $1.5 to $1.6 billion per month. One thing we also know is that this benefit of multiple and fixed exchange rate regimes happen only when you have adequate reserves. They become illusory when reserves are not adequate. We have seen an increase in inflation from 5.6% in 2022 to 9.9% in August 2023. Yesterday we got the September number, which is still 9.6 or something. And then we have seen rating agencies have downgraded the outlook of Bangladesh from stable to negative. So my point here is that the unorthodox policy model that we have followed has not really delivered the results that we thought would come from those policy. Now, we also know from various empirical research that there is a strong association between consistently tight monetary policy and disinflation. So you will not get a lower inflation through a short-term tightening of monetary policy. You have to stay with it for a while. That's why you see one commonly used phrase recently is tighter for longer. That's what you need for reducing inflation. And then the rigid exchange rates, when you have fixed exchange rates and your capital account is leaky, even though you have capital controls, but money leaks out, then the rigid exchange rates do not deliver the results that you thought they would. It is hard to hold on to fixed exchange rates if you do not have foreign exchange reserves, and that the trade is important for growth. Now, it's also important that policies maintain their consistency. Back and forth on policies affect policies' credibility. And then we also, have used various types of controls and regulations, but there could be fly in the ointment of policies. That is, excessive regulation, they induce evasion and lobbying, and that lead to further regulation. Regulation breed regulation. So one has to be very careful on what we are trying to control and how we are trying to control it. So what is the policy agenda? It's very long. That's why I'm saying reforms for economic stability and economic transformation, which has a nice abbreviation of reset. Where do we need the reset? Bangladesh Bank has already done some work on monetary policy reforms. They have introduced an interest rate corridor. That needs to be made functional. Bangladesh Bank has also introduced a smart rate system which makes the interest rate a little more flexible than it used to be under the 9% cap. But this is supposed to be a transitional arrangement, so we need to define an exit path from this smart rate system. And on the exchange rate, I think we need to kill the market killers. The fixed exchange rates kill markets. We need to get rid of those fixed exchange rates. On the fiscal side, I think the immediate priority is the restructuring of deficit financing towards more concessional external financing, keeping primary deficit below 3% of GDP, prioritization of public expenditures, particularly subsidies and the annual development program, and expanding the revenue base without increasing the revenue rates. On the financial side, we have asset quality, capital adequacy, profitability, overstated profitability, and risk issues which need to be stressed. And there are lots of structural policy reforms, a long agenda, which I have just listed the areas where reforms are needed. Now, before I conclude, as you all know, that we have this target of becoming an upper middle income country by 2031. So in the World Bank, they did an exercise on what growth rate do we need to get there. The result of that exercise was that if we want to achieve upper middle income country status by 2031, GDP has to grow by 7.8% per annum. If we fail to do that, then it may be delayed. For example, if GDP growth is 6.7%, upper middle income status will come in 2033. Same kind of exercise was done for the high income country, what is needed. And there the result was, if we want to reach high income country status by 2041, GDP has to grow by 10.2% annually. If it is slower, then the reaching that status will be delayed. It could be as far as 2061 if growth slows to, say, 5.2%. Now, so the question is, we need to accelerate growth and we need to sustain higher growth. Where do we have to work? There are three areas that are important. One is productivity growth, the other is investment, and the third is labor income for inclusion. Now, for increased labor income, we need more diversified and competitive exports and human capital development. For faster productivity growth, better urbanization and connectivity. For higher investment, stronger financial sector and FDI. But you know, the world is changing, and there are two big things that are happening in the world which we will have to tackle. One is the disruptive technological change, particularly the generative artificial intelligence technology, which is now compared with the invention of fire and electricity. This is as big as that. That is going to pose both opportunities and challenges for an economy like Bangladesh, particularly a labor-abundant economy like Bangladesh. And then there is this other thing, the climate change and the heating and cooling of climate change. And then also there are this geopolitics, where also we have heating and cooling. And I'm sure our chief guest here today knows a lot better about those geopolitical heating and cooling than I do. And with that, I conclude my presentation. Thank you very much.